Hey, you got Chico here. And let's do a weekly recap of our call option trading. So what a wild week, as we all know. And we first opened a position against Tesla. We picked Tesla. I picked Tesla because, they got a lot of bad press, and also the tariffs against China was, I would think, would be impactful to them, and to all auto manufacturers in general. So with that play, we opened it, and what was good about it is a lot of the call option trading, the premium is very high given the amount of volatility in the market, and Tesla was no exception. So we sold the contract that eventually became profitable at the end of the week. It did not go into the money, and so that was good for us. But during the middle of the week, that was not so. In the middle of the week, what happened was, Trump announced the delay on his 90-day delay on his new reciprocal tariffs, and that sent the stock market surging like up to 12%. And so at that point, if you did a covered call, you'd be fine because you'd be making money off the ownership of the stock. But then if you did go into expiration, you would get assigned and you would have to sell the stock at the strike price. Now, if you did a naked call option, that'd be very painful. Where if you didn't have the stock on hand, you did sold the call option. Now you're in a position where the stock is going up. As I mentioned in my first video of this series, explain a little bit about covered call and naked call options. So the stock's going up, right? And now you gotta go on the stock market. You gotta purchase that stock. So if it went up to $1,000, you gotta pay $1,000 a share. And then you gotta sell it to the person who owns the contract, the person who bought the contract for you. And he has the right to exercise that contract to buy those shares at the strike price. In the case of Tesla, it was at $255. So $255, and if it went up to $300, you have to go out to the market and pay $300 a share. So what was key this week was, at that point, you had to make a decision. One would have to make a decision. Do I close out my position and take whatever loss there is, or do I wait a little bit further down the week? So our call option contracts expire on Friday, and given all the news, he did put a delay on the tariffs, but he kept and raised the tariffs against China, and there's still tariffs against Canada and Mexico, and the universal 10% tariffs, I believe. So it didn't make sense to me. It still was looking the outlook was very good, very bad. But I guess everybody doesn't know what to expect. Maybe he would further roll back things down the week. So, but given the cards at hand, decided to hold on to our two positions for both Tesla and Carvana. In Carvana, we opened it because Carvana was a stock that was very sensitive to the health of the economy. Even though I love the stock, I think it's got excellent upside, but for what it's worth, the market cap, and it's very dependent on continued growth. So these were the two stocks for this week, and we held on to the end of the week. At the end of the week, Tesla stayed out of the money, so we definitely pocketed the premium and didn't have to do anything else. Now Carvana on Friday was right at the threshold of going into the money, and at the closing bell, it did go into the money, because our strike price was $205, and it was $206.20 at closing. So when we went into expiration, now we're into the money, so we would get assigned that contract. Likely somebody would want to buy those shares at $205. But that's not a problem for us because we sold the contract. The buyer paid a premium of $1.79 per contract. So times 100 shares, that's $179. But now we have to, on paper, let's say had to go out on the market at the very end of the closing bell, sell the shares to him at 205, but we had to acquire it at 206.20, right? So that's $1.20 difference between 206.20 and 205. Times 100 is $120. So we lost, in that case, if you did a naked call, you would lose $120. So $179, my $120 would put us up at $59. So we actually made money off that transaction too. So this week we're 2 for 2, I would say. And if you did cover call, you would be happy that you get the appreciation from the stock because you already held it. You know, you had it before you sold the contract, or you, yeah, that's right. You had the stock before you sold the contract. And typically, again, cover call, you have a long-term outlook, or you already happen, because yeah, long-term outlook on the stock, and you just happen to be holding the stock and you want to make money, additional money on it by selling call options. So yeah, it was a good week for us. And the key point again was that I want to discuss with you, which I have, was in the middle of the week when things were not going well for us. What do we have to do? You have to assess the amount of risk. You have to make a decision and also understand how much you could potentially lose, you know, and also relax, be cool, and think about all the factors in the market to make that decision. Okay, we'll go to the spreadsheet.
Okay, here's a quick summary on the spreadsheet. So for April 7th to 11th, we have the two trades that we made from Tesla and Carvana. Tesla, we sold it one contract at $4.30, and we went into expiration of the money, so that made $430 for us. Carvana was sold at $1.79, and we let it go into expiration, so we pocketed $179, but we did get assigned, and so we bought the shares at the closing price of $206.20 and sold it to the buyer of that contract, call contract, for $205. We would lose $120, but all in all, we made $59 on that play with Carvana, and for the week, we're up $489.
All right, so another great week for us. Last week we had a good week. Last month we had a great month. I'll catch you next time.